We like to tackle myths, so in today's Headlines in Fine Print, we're going to talk about credit report myths. Welcome back to Headlines in Fine Print, the show where we don't just skim the headlines, we dig into the fine print. I'm Dion Williams, President and CEO of Piedmont Advantage Credit Union, and I'm glad you're here. Just as a reminder, before we get into today's content, we have the show archived on our YouTube channel and Spotify if you'd like to learn more or listen to past episodes. I'd also like to encourage you to follow our channels, like, and share if you're so inclined. And with no further ado, let's look at some credit report myths. Let's begin with checking your credit. So if I check my own credit, it hurts my score. That statement is false. This is a good time to differentiate between a soft credit pull and a hard inquiry. A hard inquiry is when you formally apply for a loan, and those are the types of inquiries that can bring down your score. However, a soft pull may be when you're checking your own credit, or even some lenders will specify a soft credit pull that's used to pre-qualify you for a loan, and then they'll do the hard pull later as part of their final underwriting process. But the fine print here is that more hard credit inquiries can lower your credit score. Next, let's talk about closing old accounts. So as far as the statement goes, closing old accounts will boost my credit score. This one is not quite as clear cut. And the reason for that is that available credit and credit utilization factor into the equation. The more credit available and the lower rate of utilization are favorable to your credit score. Now, closing an old account could potentially work against you in that regard. So on the other hand, if it's a card with an annual fee and you're not using that card, or you have the type of money personality that closing out the account is better from a psychological perspective, then closing it out makes sense beyond the realm of just the impact to your credit score. So next, let's tackle the topic of carrying balances. So in terms of the statement, carrying balances helps build credit. This may be a question that's common from people earlier in their financial life because they're thinking ahead to their credit history, qualifying for a mortgage loan, or making a larger purchase such as a car. But that statement is false. Making on-time payments and keeping your credit utilization under 30% will help your score more than anything. And carrying balances, if nothing else, will just cause you to pay unnecessary interest charges. Now, this next one we hear a lot about, that in terms of credit scores are the same everywhere, and that's simply false. There's multiple credit scoring models, and two that you may have heard of are FICO and Vantage scores. But even within FICO and Vantage score, there's different versions of those models depending on the product. So, for example, applying for a credit card versus applying for a mortgage loan may produce two different scores. I'm going to refer to earlier portions of our discussion here. Make on-time payments, keep your credit utilization low, and minimize the number of hard inquiries on your credit report. Don't get wrapped up in the various numbers and models. If you do your part, don't panic over slight score variations, as they should reflect a solid credit history overall. And this next one's also another one that we hear a lot about in terms of how long it takes for activity to reflect on your credit report. So let's say you came into a cash windfall. Maybe you won the lottery, you got a tax refund, something happens, you get a lot of cash at once, and you pay off all of your unsecured debt. So it's all gone. But it may take time for those actions to reflect in your score. So keep in mind that your score is a history. So any late payments don't go away overnight, but the good news is that showing a zero balance and keeping those balances at zero or very low will work in your favor. A credit history is established over time, and creditors generally report activity only once a month. So don't expect same day or next day results in that regard. And let's move next to credit repair companies. And just as a blanket statement, beware of companies that promise instant credit fixes. 100% of the time, beware of those companies. No one can legally remove accurate negative information from your credit report file. You can dispute errors on your own at no charge. And remember, it takes time to pay down balances, and it takes time to establish a history of on-time payments if past dues are part of your history. So companies that are promising to magically make it disappear, don't trust them, not legitimate. So in terms of bringing this full circle and wrapping up for today, let's do a quick recap. Number one, soft inquiries do not impact your credit score. It's the hard inquiries that do. Number two, old accounts can help your score in terms of the zero balance and lowering your credit utilization, and you want to keep that below 30% if you can. Number three, a pattern of on-time payments and low utilization is more beneficial than carrying balances. Four, credit scores vary by the model and the lender. Five, be patient as you pay your debt off because the activity and history will take a little bit of time to reflect that activity on your credit report. And then finally, beware of credit repair agencies. Thanks so much for tuning in to Headlines in Fine Print. Don't forget to follow Headlines in Fine Print wherever you get your podcasts. And until next time, keep pushing past the headlines and lean into the fine print where the story lives. Thank you.